Good afternoon and welcome to Capital Account. It's July 13th. I'm Lauren Lyster and it has been a busy day here in Washington. And as you can see, I'm coming to you not from the normal studio, but from our bunker deep within RT's fortress balance sheet. Because if you haven't heard, Jamie Dimon was on the Hill testifying about JP Morgan's multi-billion-dollar trading loss. So we infiltrated the Capitol building to bring you the real story from inside the lion's den. Now, don't worry, we did construct a full-body protective shield that repels cronyism and dirty deals from reaching me. You know, I tried to enter through a revolving door so as to not raise any eyebrows, but hey, alas, there wasn't one. Maybe that's only for the politicians. We will give you the real lowdown, though. And we were also trying to figure out if we've seen this dog and pony show before. We found this.
This is what I'm telling you, what I'm exposing to you and the press and everybody. This is my doom.
We wish we saw a repeat of the Valachi Mafia hearings in the 1960s, where the country really got some insight into the workings of organized crime. Not the case today with Jamie Dimon. Nonetheless, we talked to Marketplace's Heidi Moore on Capitol Hill, fresh from the hearings, on what did come out of it of value. Plus, we're wondering if banker bonus arbitrage is upon us when toxic assets unloaded on bankers turn out to be the gift that keeps on giving. Or perhaps we're seeing a breed of genetically mutated bank executives who are the only ones that can digest toxic assets. These are the questions we have to ask after a Reuters report we read. We'll tell you about it. Let's get to today's Capital Account. So, you know, we were hoping the hearing of JP Morgan CEO went a little something like this.
September 27th, 1963, Joseph Valachi rips the lid off organized crime.
This is what I'm telling you, what I'm exposing to you and the press and everybody. This is my doom.
That was from the famous Valachi hearings of the 1960s, which were touted as a major breakthrough in intelligence about the mob. Well, that wasn't what we got with Jamie Dimon today. You know, what can I say? A girl can dream. That's not what we saw. But first, let's back up to quickly recap on how we got here. It's been a little more than a month since the beast revealed its true nature publicly.
Out of nowhere.
JP Morgan's now infamous London whale weighing in with at least a $2 billion loss.
Did you see that?
Before disappearing back into the vast, murky waters of the largest bank in the United States, only to rear its head again in the form of PR spin.
So banks either make loans or invest the money in securities. We have a huge securities portfolio. We're a big bank. In fact, the securities portfolio does have an unrealized gain of $8 billion. But in how we manage that portfolio, we did lose $2 billion trading.
Fishy euphemisms amidst a sea of criticism over the risk taken by a taxpayer-backed, too-big-to-fail bank and its chief executive.
He's responsible for this. The buck stops here. But this isn't financing a business or creating jobs or building plant equipment or financing infrastructure. This is gambling.
Jamie Dimon now answers to the Senate Banking Committee on Capitol Hill, where we've already seen regulators paraded before him in recent weeks.
We are assessing the adequacy of risk management throughout the bank,
with little in the way of revelations.
And the reason, of course, is that both entities, Treasury and the Federal Reserve, are so heavily aligned with the interest of the largest banks in the world, the systemically dangerous institutions.
And as far as the interests of this Senate panel, keep in mind when Jamie Dimon addresses the leaders.
Chairman Johnson, Ranking Member Shelby.
He's talking to lawmakers who can thank JP Morgan as top campaign contributor #1 and #2. That's according to the Center for Responsive Politics. So as far as too big to fail whales, London and otherwise, we may still have no assurance they won't be coming seemingly
Out of nowhere.
again sometime soon. So that brings you up to speed to today. Now, more reasons for that view I expressed at the end. The whole issue with this trade and the Volcker rule is the question of if this was a proprietary trade or a hedge, and if the trade would have violated the Volcker rule, which will aim to stop taxpayer-backed banks from proprietary trading. Now, this is the benchmark regulation, really, to try to stop a 2008 repeat. Well, listen when a lawmaker asked Jamie Dimon if we can even distinguish between a trade, a proprietary trade, and a hedge, and if so, how they'd make that distinction.
I think it's going to be very hard to make a bright line distinction between proprietary trading and hedging, because you can look at almost anything we do and call it one or the other.
They can't even be distinguished. So, let's just forget the Volcker rule. We can quit and all go home. That's it, right? Lawmakers don't buy this, do they? I don't know. Let's ask Jim DeMint.
But I would like to come away from the hearing today with some ideas on what you think we need to do, what we maybe need to take apart that we've already done to allow the industry to operate better. At the same
Yes, you tell us, Jamie Dimon, how should we regulate you? Forget your mistakes. Let's let bygones be bygones. Don't worry about what the bank did to mess up or the outsized risks you're getting away with an implicit bailout guarantee of taxpayers. Forget all that. What can we do to better serve you? So forget all that. Forget the hearing. I was there earlier. I have a much better look. Take a look. Jamie Dimon has descended upon Capitol Hill, so naturally, so did we. Now, of course, this is reminiscent of 2009 when we saw bank CEOs answer to lawmakers here for their actions related to the financial crisis. Now, of course, we have the benefit of history and the precedent that was set to know that just because they're questioned doesn't necessarily mean anything is going to change or come out of the hearing. So we're going to talk to Heidi Moore. She is the New York bureau chief, the Wall Street correspondent for Marketplace, to see if she thinks this dog and pony show will be any different. Heidi Moore, thank you so much for joining us in Washington, which is so exciting because you're usually in New York.
And the weather is cooperating, which it never does in Washington, so lots to be thankful for.
Absolutely. The sky is parted for Jamie Dimon because that's what happens here on Capitol Hill. So now that we have seen him testify and we heard him say that the Volcker rule is not necessary, get a little defensive still over TARP, but really, do you feel like anything new was revealed in terms of this trading loss, or do you feel that Jamie Dimon was even really brought to task?
He definitely wasn't brought to task, I think. There were only a couple of senators who were really tough on him. Merkley, maybe Brown, maybe Menendez. But everyone else went out of their way to say how smart he is and how good he is at running a bank. And, and they all wanted to paint each other's toenails, basically. It was a love-in in that sense. But I think in what he said, there were a couple of things that stood out. Number one, his willingness to at least say that personal responsibility lay with him was interesting. So, he said, I was dead wrong about calling this a tempest in a teapot. I take personal responsibility. The buck stops here. That's just good strategically because it takes the wind out of the sails of people who say you're not getting it. But if you look a little deeper, there are some other interesting nuggets. One of the things was that he said that the trading loss came about because JP Morgan was planning to make a profit if there was a global financial crisis. So that tells us a lot about the motivation of that trade. It tells us last year JP Morgan was expecting a global financial crisis, which makes us think back to 2008. We saw how awkward things were and how easy it is to tip off the financial markets into chaos. So what I would have liked to see at the end of that thought is a $2 billion trading loss at one of the biggest and most secure banks in the country could be the kind of thing that throws the markets into panic because it comes out of nowhere. But he didn't say that. So if they're preparing for a global crisis, they know that a panic could start at any minute, but they're not really acknowledging their role in that.
Right, great point. Now, along the lines, too, of what this trade even was, when we first spoke about it, it was right when the London whale trading loss news broke. You said, if this is a hedge, this is a unicorn hedge, because I have never seen it before. We've never seen it before. Now that you've heard Jamie Dimon's explanation, and of course, all sorts of other news has come out in the meantime, do you feel ever more strongly that that's what this is, a unicorn hedge, or not a hedge at all?
I don't think it's a hedge at all. I mean, Senator Menendez said something pretty funny. He paraphrased Shakespeare, to hedge or not to hedge? I don't think in the 16th century this phrase would have been so sonorous or had such resonance. But the question is, was this a hedge? And so Jamie Dimon was saying this was a hedge, right? But in another way, he said, we were looking to make revenue on it. When you have a hedge, you don't look to make money. You look to not lose money. So you should be roughly equal. It should come out at zero if you do it right. But they were actually making a bet. And he said that in his own words. So now I think that's really interesting because we can just dismiss the whole hedge thing. It was a unicorn hedge. It doesn't really exist.
Doesn't exist. Put it to bed once and for all.
Exactly. It was just a bet. And Senator Menendez said, you said it morphed. Did it morph into Russian roulette, right? Again, taking that issue of risk, right? So you're actually making a bet. Are you acknowledging the risk? Because when you and I talk about risk, we hear the word risk. When you say that to a banker, they hear reward. And that's exactly what was going on there. That said, it seems like they have fired nearly every person related to that hedge. So we have to see, it's really hard to look now into the future and see if that will happen again, because all the people responsible for it before are gone. So it's really hard to tell what situations could occur again at JP Morgan to convince them to take that bet again, or is this a turning point? Are they going to back away from that strategy? Because at this point, it's really the future that matters.
Right. Well, you know, I want to back up a little bit because when you're talking about, okay, this isn't a hedge, when you talk about Jamie Dimon's explanation of what their biggest liabilities are, he says loans. But when you look at the numbers, when you look at their loan portfolio in 2008, I think it was $744 billion. Its CIO portfolio was $113 billion. Over the next couple of years, it scaled down its loan portfolio by about $50 billion. The CIO portfolio, you would imagine, would then shrink too, but it tripled. So why would JP Morgan be diverting cash into hedging if it was reducing its loan portfolio?
Because it's profitable. That's the thing. I mean, they saw the profits that were coming out of that unit, and they see the profits from making loans falling, the profits from advising companies and corporations falling, and they see the CIO profits rising. Where would you put your money, right? I mean, that's what they saw. But of course, they may not have taken into account the fact that those profits probably couldn't rise forever, and they put probably too much faith in the CIO to make that kind of revenue for them.
Speaking of putting faith in the CIO, I know that Jamie Dimon may have taken responsibility for this error before lawmakers, but former executives have come out to Bloomberg and said that Jamie Dimon gave the CIO kind of a free pass and didn't apply the same scrutiny to them when it came to risk management that he did to, say, investment banking. So do you think Jamie Dimon will really pay for that? Do you think he would ever stand to lose his job or to lose compensation going forward? I mean, is he really going to be ever brought to task?
For this one loss, I think it's probably dubious. I would say the answer to that is no. And you would also have to ask, if he is gone from his job, one of the positions that Jamie Dimon occupied was that he was not just, you know, the head of the most profitable bank on Wall Street, but also a kind of moral authority. JP Morgan was the one bank that had not really screwed up big. And so they didn't, as we said before, they didn't have those scars and those wounds teaching them, don't go here, don't do this, don't take this risk. So if you take Jamie Dimon, who has run JP Morgan profitably for a few years, out of JP Morgan, who do you put in there? Ken Lewis? Stan O'Neill? I mean, you know, so that's, I mean, there's a reason here that people are looking at the scale of the loss. The money itself, JP Morgan can handle. I mean, it makes us raise some questions, but they can handle that. But then look at the issue of leadership into the future. We are at the brink of a global economic crisis right now. Europe is in trouble. China is in trouble. If we're going to try to remove the head of a major bank, let's think about who's going to do a better job. And that's what's protecting him right now. There's so much uncertainty that who has the time for a job search?
You hear that? Cleanest dirty shirt applies to bank CEOs as much as to currencies. But coming up still ahead, who do we have more disclosure from anyway? Too big to fail banks or the mob? We'll have more from my interview with from Capitol Hill with Heidi Moore. She'll answer that. But first, your closing market numbers.
What drives the world?
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued
with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
Welcome to the Alona Show, where you'll get the real headlines with none of the mercy. The problem with the mainstream media today is that they're completely disconnected from the viewers and from what actually matters to those viewers. And so that's why young people just don't watch TV anymore. If they want news, they go online and read it. But we're trying to take those stories that people actually care about and transfer them back to TV.
Welcome back. Lawmakers may have let Jamie Dimon off easy earlier today, but we are not. So I asked New York bureau chief and Wall Street correspondent for Marketplace, Heidi and Moore, about Dimon's explanation for how and why they got into this irresponsible, risky situation at JP Morgan's CIO in the first place. Going back, he was talking about that when they were going to be anticipating higher capital requirements, they instructed the CIO to reduce its portfolio, reduce some of its risk-weighted assets. Instead of reducing the portfolio, what they did was they added to it to offset those existing positions, which made it larger, more complex, and riskier. How are we to look at this? Is this just an indication that management is stupid, that they didn't exit some of these positions when they could have?
Well, I think it is a lapse in management. I think anyone would say that, and JP Morgan should definitely admit it. It seemed like they were today. I mean, they have to watch what's going on in those units, and they admit they were not watching what's going on there. And you can see how things get out of hand. The fact that these two traders could go ahead and take these bets and then what looks like double down on these bets while they were supposed to reduce them, while the CEO thought they were reducing them, while their managers thought these risks were going down, that tells us that the oversight was not strong enough. And it's really hard for a bank to talk their way out of that, because you can say we fired the people responsible, but what are the chances that those people were really evil or planning to commit fraud? They probably weren't. You know, that's why we have backstops. That's why we have other people watching over. And when you have so many levels of management not watching over what's happening, that's how things fall through the cracks. I don't think things fall through the cracks. I think they fall up.
Fall up.
Yes.
Interesting. And when it comes to, you say that those people are gone, we can't really assess if this risk will continue to be taken. Are we to assume that if this is going on at JP Morgan, it's going on more broadly, and this is a canary in the coal mine? And if they see JP Morgan get away with this coming out of this trading loss, are more banks going to be getting the green light to do this kind of a thing?
Well, if other bank CEOs think they're Jamie Dimon, I'd love to see that happen, because he did come into this with a 5-year-long halo around him that he was, you know, the best bank CEO, and, you know, several of the more adoring senators mentioned that to him. There was a lot of love for Jamie. I can't think of other bank CEOs who could do that, who could pull that off. He had, you know, some social capital to spend going into that room. But the question is, are they doing it? Then let's try to figure out what the root causes are of what JP Morgan was trying to do, right?
Well, does it speak to a problem with derivatives, that it's more difficult to exit existing positions? It's easier to try to hedge them and add on to offset, but then you add more complexity and risk.
Exactly, and that's if you're being rational, right? There's also the emotional aspect of, I made this giant bet, I put, you know, hundreds of billions of dollars on it. I can't accept that I was wrong to the tune of hundreds of billions of dollars. A lot of people can't accept that they're wrong about washing the dishes, right? So imagine something to this level. So there's that emotional aspect. You know, there is, I don't know if the problem is with derivatives or whether, you know, derivatives or these complex products, because they require so much intelligence, bring out a lot of hubris and a lot of ego in people. They set up the wrong kind of incentives. You get paid a lot if you get it right. Everyone says how smart you are. And so it's really hard to back away from that and say, I was wrong, I'm humble, and maybe I don't deserve that big salary. And so I think that lure is especially there with derivatives. Intrinsically, there's nothing about them that, should be necessarily evil. It's how we treat them. So I think that's one aspect of it. And then also, other banks have the same problems with profitability as well, right? Why do they resort to derivatives? Because the basic products of banking are not as profitable as they were.
Well, let's talk about who's to blame for that. Looking back at the numbers, back in 1960, banks had 60%, I think, I need to check that number, but 75%, excuse me, of their excess cash was in treasuries. You fast forward to today, and they have the average bank 6% of its portfolio in U.S. treasuries. The rest is in corporate bonds and other products. So who's to blame for that? Is that the Fed?
Well, in part, treasuries are yielding less. But if you really look at it, you could blame the Fed. I mean, the Fed has been taking a lot of blame. They can take it. They can take more, I think. Definitely, those low interest rates are a problem. But, another problem is that, okay, so what's yielding more? What's safer and yielding more than treasuries, right? If treasuries were this low and you couldn't make money in them, fine. But also try to put it in corporate bonds, try to put it in high yield bonds, try to put it in stocks. Everything's really volatile, it's moving around. So what people are trying to do is basically break up their portfolio so that they can get like a little inch of return, a little skim of return. And partially that has to do with treasuries, but partially it has to do with every other asset class.
Mm-hmm. That's really interesting. And just on the $2 billion loss, I want to make sure that I'm clear, because people have said, okay, this is not big when you look at how big JP Morgan is. They can handle it. But does that distract from the bigger question it raises, which is what kind of risky bets are taxpayer-backed, too big to fail banks making? And does this make the case for a strong Volcker rule, even if Jamie Dimon says we don't need one?
Well, the Volcker rule is particularly problematic. You'll notice that one of the senators said something like, you've said you don't know what the Volcker rule is, we don't either.
Hi, Jamie Dimon, ask your lobbyists, why don't you? Because they probably have a good idea of what the final draft is going to look like.
Exactly. If anyone has any idea, right? The Volcker rule, no matter what side of it you're on, is currently a mess. It's at 300 pages. It's not really definitive. And, a lot of people are still saying we don't know what it governs. So it's really hard to get behind it because of the specifics of its situation. It's just a mess right now, even if the idea may be sound. So that's part of the problem that is facing this whole thing. Who can stand behind something that's not really strong? You saw that partially in that room, but also, there was no one in there who wanted to stand up for Dodd-Frank. Dodd-Frank is dead and gone at this point. For the Democrats, it seems like just a giant defeat they don't want to think about. For the Republicans, they figure they already did the work on this 2 years ago. Why are we back here again? So in many ways, the whole issue of reconsidering this is a nuisance because people have to campaign.
Right, and speaking of campaigning, these guys in the Senate Banking Committee, a lot of them have to thank JP Morgan as their #1 and #2 contributors when you look at the chairman and the ranking member. So obvious conflict of interest there. But I do want to ask, if you had to compare this to what this hearing should have been, given the historical context, should this have been Pecora hearings, which led, of course, to Glass-Steagall? Should this be the Cosa Nostra hearings of the 1960s, where we got real insight into how the Mafia works? Or should this be 2009, give the bankers a little spanking and have them be on their way and give political theater to the public?
Well, I'd say the Mafia probably has better disclosure than the banking industry. I mean, one of the problems with making this as hard-hitting as it could have been, and that a lot of people feel it should have been, is that banks don't have to disclose anything they really don't want to. I mean, the baseline of SEC disclosure is very low. So what JP Morgan's been saying is hang in there until July 13th, when we will reveal all. I would question that. Everyone, if they say that, you do have to hang on, because what can you do? You can't push for information you can't get. But how much are they really going to say on July 13th? I doubt not much, because they want this to go away too. And we also have to ask ourselves, what do the forensics of this one trade really tell us? We may get the postmortem on what happened, but the bigger question is, what does this mean for JP Morgan, and what does this mean for the banking industry? We should be focusing on those questions now, and it's $2 billion loss. I don't want to say bygones, because it's not bygones.
Right.
But the mechanics of that, no matter how deeply we get into the details, aren't going to tell us what we really want to know.
Which is how to get the banks to disclose more than the mob. So Heidi Moore, we're going to leave it there for today. Thanks so much for being with us.
Thank you.
All right, I'm back in the studio to wrap up with loose change because 3 years ago, around 2,000 employees of a certain bank were forced to take $5 billion from the riskiest assets from the bank's balance sheet as their bonuses. Can you guess which bank?
It's been 2 weeks since I called my mother. Am I really that busy?
I need to decide about that new job.
Credit Suisse Life and Pensions. Invest in life.
Yes, Credit Suisse certainly invested in the lives of their employees with toxic assets, but now they're offering the deal again. Why? Because the original toxic assets offered as the bonuses yield an 80% gain for the workers. That is according to Reuters. So this does not add up, okay? Toxic assets kill everybody else, but for bankers, when they're given as bonuses, they yield 80%. Yeah. What explains this?
Well, I think when this first happened, obviously they were kicking and screaming because they didn't want these, right? But I think what happened is you introduce this toxin into the environment, and as we've seen with frogs and double tadpoles and things like that, they mutated. So I think what effectively happened is these bankers...
Jamie Dimon, this is his real
Jamie
mutated
Dimon, and
form.
he mutated in order to literally evolve with this new ecosystem, and now they're able to actually swallow up these toxic assets like that oil-eating bacteria in the Gulf, and they're able to actually make profits off it. So leave it up to these guys. I mean, they can generate profits from anything. At this point, I think we should just introduce these bankers into any hostile environment that we have, whether it be, throw them into the Gulf. All right, if we have oil in the Gulf,
they should eat up the oil. They can handle it.
They can handle it. If they can handle toxic mortgages, okay, and car loans and student loans, we should be throwing these guys into the Gulf, into estuaries that are polluted. All right, join these guys up with oil executives, and we might have some solution. Forget oil-eating bacteria.
We only have 30 seconds, but let me pose this. Could this be some kind of banker bonus arbitrage where the bank reports these as toxic assets, secretly knowing that really this is the good stuff?
You know, that's an interesting point, but I think what's more likely is that they're adaptable. They're different. Their genetic code is such that they can mutate at a faster pace. Yeah, these guys are mutants.
We have to leave it there with Dimitri's final wise words. Thank you so much for watching. Be sure to come back tomorrow. And in the meantime, you know you can always follow me on Twitter at Lauren Lyster and give us feedback on this show and subscribe. Catch any you missed at youtube.com/capitalaccount. Plus, you can check out our show in HD on Hulu, hulu.com/capital-account. From everyone here, thanks for watching. Have a great night.